Hello, welcome everybody. It probably says something about the subject matter today, or maybe it says something about the guests that we've got to talk about the subject. That there are so many of you joining us today. We are nearly at 150, so thank you for joining us on this call. I'm Neil Alexander. I'm the Markets and Consumer Insights Manager at Fair4All Finance. My role today is mainly to try and keep a pretty packed agenda to time, hopefully with the help of our finely tuned, ready and able guest speakers. Before I introduce them to you, a little bit of housekeeping. All of the slides that you see today will be available to you after the webinar, so there is no need to screenshot them. There is no need to take feverish notes unless you are desperate to do so. There is a report that will go with the slides that you'll see from the University of Salford, and Pal Vic will refer in his presentation to how that can be accessed. That report is much more detailed than the slides, and it's well worth your time. A recording of this webinar is being made, so there is an opportunity all the way through the webinar to use the Q&A button at the top of your screen. That's about as technical as I'll get, I'm afraid. The Q&A button at the top of your screen, that's there for you to post any questions or comments or observations. Just remember that it is a live recording, so your comments will be available, and you just might want to be just thinking about the sensitivities of those as you put them in. My colleagues, Max Holloway and Temi Odesonia, will be assisting me throughout the next hour, either sifting through the Q&A stuff in the background or helping us keep on track. So, our running order for today. In a few minutes' time, I'll unleash Dr. Pal Vic from Community Finance Solutions at the University of Salford onto you. Paul will talk through his research, looking at the impact of the cost of living crisis on both lenders, community finance lenders and borrowers. Then we'll pass on to Simon Gregory, Sales Manager at Data on Demand. Simon will give a quick overview on what he's seeing in the application data for high-cost short-term credit, not community finance. I've had the chance to see both the presentations, and there's some illuminating information in both of those, so stick around. After Simon, it's my colleague Kate Pender from Fair4All Finance, who will take a few minutes to outline some of the areas where Fair4All Finance think that we can potentially make a difference to support community lenders, to assist where we can with the challenges that both Paul and Simon will outline. That's a little spoiler for you there. The stuff is sobering. Finally, as if that wasn't enough for you, we'll get to our three other terrific guests from two credit unions and one CDFI. So we've got the chief executives of Moneyline, of North East First Credit Union, and of Serve and Protect, and they will share towards the end of the hour some of their experiences, what they are seeing, what might chime with what Paul and Simon are talking about, and maybe areas where it doesn't chime so much. So let's have a look. Temi, next slide, please. When we asked Paul to do this research, it was a good few months ago now, and we had just come from the then Chancellor's, remember him, a guy called Sunak, the then Chancellor's £37 billion package to assist households through the crisis as it was unfolding at that time. Resolution Foundation, amongst others, were predicting then that there would be a cash gain for the lowest income households of about £1,200 at that time from the 37 billion. Since then, since May, things have not got any easier for households, have they? Energy forecasts have rarely been out of the headlines, culminated in Ofgem towards the end of August, confirming that, and that's the teal column on the slide in front of you, confirming in August that the winter fuel bill was going to rise to just over £3,500 from October the 1st. So worse than that was being predicted into next year by organisations like Cornwall Energy and the like, and there was talk that come January, the 4 million people who were on prepayment meters, 4 million of them, were going to have to find something like £600 and more just to pay January's fuel bill. So something something must be done. Last week, just less than a week ago, the new Prime Minister made what appeared to be a commitment to peg energy bills this winter, and that is the orange column on the right-hand side of that graph, pegging bills to £2,500, with all of the 37 billion from May, from the Sunak Chancellor announcement, still in play. So things like the £400 reduction that we're all going to see on our bills, that type of thing. This is a monumental cost attached to this intervention, something between 100 and 150 billion pounds to be addressed later this month at the so-called fiscal event. So whilst there is some certainty of capped bills for households, all households, for the next 2 years to allow some planning to be done, you can see from this chart that even though it's going to be at £2,500, it is still over £1,200 more than the winter fuel bill of last year, and that's with inflation still at 10%, likely to be reducing more slowly into 2023. The costs to low-income households remain, as many people on this call will know, and all of you in the audience will know, remain pretty much overwhelming. Median income for the lowest quintile is about £14,500, and there is a disproportionate spend on food, on fuel, on energy, on broadband, rents, and whilst the energy bill looks significantly better at £2,500, it is not going to stop the worry for households. The truth is, there's always been a cost of living crisis for millions of households, and while there's a real issue at the heart of this of income, or rather lack of income, what people have and what they earn, the impacts on lenders and borrowers is getting pretty intense, and that's why we wanted Paul to look at this. Paul has been working on these types of subjects for many years. I've been fortunate enough to work with Paul on a number of occasions. The work at Salford always stands up to scrutiny, and we're delighted that he's here to present a take on his findings of his very recent research. Paul.
Hi, good afternoon. Thanks for that introduction, Neil, and thank you to Fair4All for funding the research and for organising this webinar. So, as Neil said, I'm going to be presenting the results of a very recent study that many of you contributed to, looking at the impact of the cost of living crisis on credit unions and CDFIs in Britain, and this research I've been conducting with my colleague Andrew Wallace, who's unfortunately unable to be here. Next slide, please. So I'm sure you've all seen a variation of this chart before. It shows the increase in inflation, which has been significant over the past few months, and the consumer price index is in July this year was at over 10%, up from 2% at the same time last year. And that's driven by energy, fuel, and also food. And as we know, these are sort of, as Neil mentioned, these are sort of the biggest. These are a big part of the expenditure of low-income households. So inflation is actually worse for the people who are at the bottom of the income distribution and better for those at the top. Next slide, please. And wages, but also benefits, have not been keeping up with inflation. So regular pay fell by nearly 3% in the year to March-May 2020, which is a record fall. Next slide, please. So we've been just a few bit of background about the study. So we interviewed 25 managers of credit unions and CDFIs between the end of May and beginning of August. The interviews looked at on the impact of the cost of living crisis on customers, but also on lending activity, as well as operational and financial effects. We also had organized one online focus group with 4 loan officers from one CDFI and 2 credit unions. So you can see in the table as that's the sort of makeup of the sample. There are 8 CDFIs, including some of these new fintech-based providers, and the remainder credit unions, with the majority being community credit unions and most providers being sort of mid-sized. In terms of the findings I'll be reporting on in this presentation, these are sort of widespread across a range of different types of lenders, and they are also sort of material or significant within the organizations themselves. So I'll be talking you through 6 headline findings. The first is that the current crisis is seen to have reduced the access to affordable credit because lenders are having to decline a greater proportion of loan applications. It's become harder to assess loans because the circumstances and behavior of customers is more fluid and unpredictable. There seems to be a change in demand and in the nature of lending to sort of smaller loans to help people cover sort of necessity and living costs. Savings growth is either sort of falling or less than what we expected it to be because members are withdrawing more savings and depositing less. It's a little bit mixed when it comes to portfolio quality, but it's sort of mostly pointing to deterioration in quality. And the final point is that there are in some fairly significant cost pressures and income pressures on providers, but they are sort of constitute an existential threat to some, but is manageable for others. So the around 14 to 15 of the 25 lenders we interviewed reported that they were declining a greater proportion of loan applicants, including from people that they would have lent to in the past, so existing clients that they're no longer able to lend to in a responsible way, and the increase in the clients is sort of significant if we look in terms of percentage points, ranging from 6-7% up to sort of 15 percentage points, as we see in this quote here from a manager of a credit union who saw an increase in declines from between 45 to 50% up to 60%. And the most significant, the most important driver of this is that there's been a deterioration in people's circumstances. In some cases, this has been as a result of COVID, because people emerged from COVID with higher debts and lower income. In other cases, it's just the cost of living crisis. But it's also other things going on. So lenders are seeing an increased value and volume of unsecured debt, consumer debt, especially, as I'm sure you won't be surprised by, buy now, pay later, and that's contributed to increased declines. And the final point is also, as responsible lenders, they have had to introduce stricter criteria around lending and affordability, so including stuff like having a higher requirement in terms of discretionary income, and also using open banking to verify expenditure. Next slide, please. Okay, so it's more difficult to assess loan applications. That's at least what the feedback we've received from many lenders. So prices obviously is very fast moving, but so is sort of customer behavior. It's also quite dynamic, and I'll come back to a couple of examples of that in the next bullet point. And that's especially in the sort of subprime segment. So it makes it quite difficult then to use traditional underwriting and assessment methods. So, for example, using ONS data to estimate expenditure is quite difficult because it's so out of date because of these fast price rises, but also asking customers to assess what they think they will spend is also quite difficult. There are a couple of examples of applicant behaviors which are concerning. So these are not widespread across the sample, but they are material within those organizations that have seen it. One of that is that borrowers are, as soon as successful loan applicants receive a loan, the lender then receives a notification that this person is now into bankruptcy procedures. So it looks like they're sort of maximizing liquidity before they go into this procedure, which is obviously problematic for lenders, but also that borrowers are or applicants are applying from multiple sources, which means that they might end up with multiple loans, or in some cases they'll decide not to pursue an application with that particular credit union or CDFI because they already have loan, and that obviously causes difficulties. So there's one interview here from a CDFI saying they can end up with maybe 2 or 3 loans, which obviously makes for a difficult decision. So I know there's been a big change in terms of buy now, pay later, and that's now there should be more information about this. So obviously our interviews were sort of just along the time that change was made in June of this year. But lenders are reporting and loan officers are reporting that this is still this is problematic in many cases, partly also because borrowers themselves are unaware of. They just think, oh, it's just a small payment, but that really don't understand the full sort of cumulative effect of having multiple payments, so they don't generally perceive it as credit. Next slide. So, demand and lending is changing. So about 8 or so lenders are reporting that they're seeing an increase in demand and in lending. Part of that is linked to that some providers have had recent marketing campaigns. Others have get quite a lot through online lead generators, but they're also then shifting to sort of better off lower risk clients. The majority of lenders are experiencing lower than what they expected in terms of growth in the value of demand, and especially lending. And one of the things that we're seeing that lenders are seeing is that the loan amounts are both applied for and dispersed tend to be smaller because people, you don't make that large purchase now. You decide to postpone making home improvement or anything that's sort of non-essential or more luxury item. People are probably deciding that, well, I could probably do that after all of this subsides. And there were people saying that this is sort of also that people are applying for loans, sometimes are specifically saying that they are doing it to cover living costs and sort of help them tie them over. So less of this sort of aspirational purchase that maybe some credit union CDFI and CDFIs would have seen in the past. Next slide, please. The savings is lower than what expected. That seems to be in most cases. It's either lower than what they expected, or in some cases it's declining, and that sort of is coming from all ends. And it seems that fewer people, especially people on low incomes, top up savings. So people would, if they had a spare £2 or whatever, but they would use that to top up the savings, and loan officers and manager are reporting sort of less of that. More people are wanting to get access to savings that are used to underpin loans, and share withdrawals are increasing and share intake is falling. So it's sort of coming from all ends. And that's this top quote here about a credit union who's for the first time in its history has seen an outflow of savings in March, which is normally the first 6 months, I guess, is normally the period where you build up liquidity in credit unions. Part of that is down to what I'm sure some of us have experienced, that some people have. Some people did accumulate additional savings during COVID because there's nothing to spend it on. So that's just sort of part of the idea that maybe they're drawing on that instead of taking out so it's not just excess savings in a way. But there's also reports that people are taking out savings to pay for living costs. So as this manager said, you know, for many people, their rainy day has arrived and it's now time to draw on the savings. Next slide, please. So portfolio quality is a little bit mixed. I guess it'll take some time to translate into it, and obviously also lenders are cautious in terms of the lending. But several lenders are seeing sort of an increase in seeing a deterioration in quality. So around 8 to 10 lenders might be seeing a combination of increase in missed payments or loans written off, or in some case provisioning linked to that. But other lenders are not seeing any sort of deterioration so far. So obviously most lenders are, as responsible institutions, mitigating against increased delinquency by being, as I mentioned before, that they are having a stricter lending criteria, and also unfortunately, they are sort of having to restrict the amount of lending they can do to these higher risk segments. But most lenders are expecting that delinquency and provisioning will increase, especially on loans that providers made perhaps in the run up to the cost of living crisis before anyone were aware of sort of the real extent of it. And as this interviewee says, that sort of this the biggest concern is still ahead when people are going to be drawing on the electricity to put the heating on and more lights and so on. And obviously, loan delinquency is a significant risk for the sector because it's a big loan cost. Provisioning is one of the biggest costs, but it's also one of the biggest sort of sources of volatility. Next slide, please. So there are, in some cases, quite significant cost pressures. So suppliers of software or platform costs or other things are increasing their bill. There might be increase in rent and also increase in utility bills. But the biggest one that we came across is sort of in terms of recruiting and retaining staff, so that lenders are having to increase their salaries to attract new staff and also to retain staff, but also to support people who are also affected by this crisis. As I'm sure most of us are, the managers were very uncertain about how this whole thing will pan out, whether how the cost of living crisis will develop, and how the customers and how their own sort of finances will be affected. But it does, for some lenders, did see this as a potential existential threat, because it potentially lowers their income, increases their costs, increases their bad debts, and also it comes at the back of COVID. So COVID, for a lot of lenders, would have shrunk their loan book, so they perhaps emerged from COVID with a smaller loan book to generate income. So there's one interview here being more concerned about this than the financial crisis. Others are, well capitalized and profitable not to weather any crisis, and they're not sort of that concerned. They're more concerned about their members perhaps than their own financial position. Next slide, please. So obviously we don't sit on sort of the definitive answers as to how the cost of living crisis will affect the sector and its customers. This crisis is still unfolding. There are further price rises expected later this year. Obviously, there are, which has been perhaps slightly less covered, is also there are sort of increasing interest rates as well, which might have trickle-down effect to private tenants and so on. So I think there's a lot of uncertainty. There's also uncertainty about what's going to happen in Ukraine, with the war in Ukraine and sanctions on Russia, and also what government's going to do. We have some idea, but there's still some specificities to come out of that. One of the big things is also is the effects on low-income households, whether that will be short-lived or something more long-term effect. So, but I think there are two sort of things that come out very strongly from the qualitative and the quantitative evidence that we've collected. One is that the combination of rising living costs, long-term sort of financial precarity, which is part of the reality of a lot of low-income households, and COVID has pushed a lot of customers into sometimes very severe financial difficulties. The impact on lenders, on the other hand, is much more uneven and also uncertain, but it does pose an existential threat to some lenders, perhaps especially the smaller sort of community-based ones. Next slide, please. Right. So what are the implications we draw from it? Well, it does look like the crisis has reduced access to affordable credit, and I think it's important to determine and monitor in the future if that's short-lived or if it will be curtailed in the long run. I think it's fair to say that some forms of credit, especially buy now, pay later, have not really helped households manage their finances, but it's actually lead to a worsening in terms of the financial difficulties. And I think that raises big questions about customer detriment and also regulation, which I know there is sort of work being done around. Many borrowers are likely to emerge from the crisis with higher debt, less savings and lower incomes. I think an important question for us is sort of how do we enable the affordable credit sector to support customers to build resilience? You know, what support and products do they need? And the final point is that it's although the vast majority of providers seem to be confident about surviving this cost of living crisis, even closures of one or two or a few providers may affect sort of the access to affordable credit. So it's important to monitor this so it doesn't significantly worsen for some groups. Final slide, please. So there's lots more of this in our report, which we will put on after this webinar on our website, which link you can find there, and you'll be able to find this when all the slides are circulated. Thank you.
Thank you, Paul. As Paul said, there is lots more in the report that will be made available. There is a lot already in that presentation, and you will, just to remind people, all of the slides you see will be available to you after this webinar, and you will maybe want to reflect on some of those slides and take them in a bit more detail later on. We are already seeing questions in the Q&A box. Thank you for that. And some of those questions we will be covering in some of the speakers to come. So there's questions about the changing nature of applications, about loan values, about debt consolidation, and we will absolutely be covering off some of those issues. So thank you, Paul. I had asked Paul many times, I think, to make sure he could stay within 20 minutes, and thank you for doing so, Paul, and keeping us to time. Simon Gregory is up next. Simon might pick up on some of these points from the high-cost short-term credit applications that he is looking at in a second. I met Simon a few months ago. We shared a platform at the Consumer Credit Trade Association conference, and he had some fascinating insight then, and we wanted to try and get some of those insights across a wider audience here. So Simon, tell us a little bit about data on demand, if you would, but tell us a lot more about the assessments that you have on high cost short-term credit applications that you're seeing. Simon.
Yeah, thanks Neil, and morning everybody. Thanks for giving us a bit of time this morning. So bit of a brief intro for me. So Simon Gregory, I'm the sales director here at Data on Demand. So I joined about 2 years ago now to take on that role, help kind of scale up the business and the alternative data proposition that the company has in the UK. So prior to that, my background is most recently 7 years with credit reference agency TransUnion, or Call Credit as we were previously known. I was heading up their alternative finance and fintech team there in the UK. So I'm coming to you guys from our Leeds head office this morning, sunny Leeds at the moment, which may be one of the last times I say that as we start to dip into winter. But I currently live over in Manchester as well. So a bit of background on me. On to the next slide, please, Tammy. So I'm going to imagine that the majority of the people on the call won't have kind of come across Data on Demand as of yet. But to give you a bit of a brief background, we're an alternative provider of consumer data in the UK. So run and also set up by a team of credit reference agency professionals, including myself. And predominantly, our data focuses on on data captured from online consumer applications. And most prevalent for today is probably the data that we capture through online loan applications, particularly for high cost short-term credit. So what we do as a business is we aggregate that data and data from a number of other online sources that we capture, and we provide it back to lenders, but also to people in a number of other sectors to help them get a better understanding of their customers' current circumstances, and also then to make better decisions on to provide better customer outcomes. So we support lenders and other companies with decisions right across the kind of life cycle of the relationship they have with their customers. So we can help them with ID and fraud prevention at the front end. We can also help with things like affordability and other risk decisioning. We also help at the back end, for collections and recoveries. But the focus today is very much going to be on kind of what we're doing to help firms monitor consumer vulnerability, and specifically what we're seeing in the UK finance market from those applications for high cost short-term credit. And apologies up front for maybe some reiteration of some of the points that Paul made beforehand, but I think it's quite interesting to follow that and to see some of the synergies with conclusions, etc., and some of the trends that were being seen from Paul's data in the data that we see as well. If you want to go across to the next slide, please, Tammy. Thank you. So without wishing to state the obvious, it's obviously the point of the call. We have a financial crisis in the UK with cost of living at the moment. So lending, as you will all be aware, is a risk decision. In times of volatility like we see at the moment, then it's more difficult to predict that risk, and therefore lenders start to restrict access to credit as they increase the benchmark for consumers they're going to take on. So demand in the meantime, certainly what we've seen, is continuing to increase, but due to the factors in the market, the regulatory requirements, but also those tightening risk restrictions, there are a growing number of individuals that now can't access that credit. And one of the things we try to offer and we're seeing asked for from firms is them looking for alternative sources to better understand their customers' current circumstances. On to the next one, please, Tammy. So if we focus now on kind of UK consumer vulnerability, this is something that the regulator is acutely aware of at the moment. So they published their Financial Lives survey in 2020. So within that, there was 24 million UK consumers that were identified as having characteristics of vulnerability. And specifically within that, they called out the use of high-cost short-term credit as a key indicator. All of that data and the analysis they did, I'm sure some people will have read and consumed that in detail. That's all pre-pandemic. That's all pre-Russian invasion. It's pre-cost of living crisis that we find ourselves in now. So the expectation is, certainly from the regulator, and I think from what most people are seeing, is that that situation is only continuing to worsen. As I said, that's backed up by some of the information that Paul shared. We're also now seeing the regulator put into practice regulations to address that. We're all, I'm sure, been deep in consumer duty, and the deadlines for that are fast approaching. But the regulator certainly made it very clear of the types of proactive activity they expect lenders to be taking to try and support customers in vulnerable circumstances. Go on to the next slide, please, Tammy. The last bit of product to sell from me, and then we'll try and get into some of the interesting parts. I have been asked to keep it fairly brief, but happy to follow up with anybody who's got any interest. So what we did at the start of the pandemic is decided that we would create a product that could help lenders do what they were being asked to do, not just from a social perspective, but also from a regulatory perspective. And that was to identify characteristics and trends of vulnerability. So we did that through focusing on the high cost short-term loan application data that we see. We see several, nearly 1 million applications come through those channels every month. A lot of that is from people, repeat people who've been seen using that type of credit before. And what we do within Data on Demand for our ID View product is collate all that high cost short-term credit data. We also supplement that with other data sources, particularly one that some people may be aware of from the Vulnerability Registration Service. So they provide instances of declared vulnerability within consumers. So we collate all this data together. At the moment, the data set sits at just over 3.3 million UK consumers. High level, that's cut down and classified in line with the FCA requirements of highly vulnerable, currently vulnerable, and historically vulnerable. But below that, there's over 100 kind of unique variables that we see from the data applications that are made. If you go on to the next slide, so this kind of comes down to some of the points that Paul was making in his presentation. The data that we're seeing definitely has some connotations around decisions that lenders are going to need to make, and also policymakers and regulators are going to need to make. So not only are we seeing the application volumes for these high-cost short-term loans increase, but we're also seeing a number of people turning to high-cost short-term credit for the first time. So it can be quite difficult to prove that the link directly, but the general expectation, and certainly our expectation, is that this is being driven by changing circumstances for those individuals. So potentially loss of income, loss of employment, obviously increase in cost of living, but also the points that we've raised before around the reduction in access to credit by lenders squeezing their criteria. We're also seeing some really probably things you would expect, but when you put the numbers around it, further worrying statistics, which is specifically looking at some of the reasons for these applications. So I've highlighted a couple of the interesting ones here. Again, more than happy to go into this in detail and even do kind of portfolio analysis with different firms and different sectors as well. But if we focus purely on things like applications for household bills, which is clearly directly related to the cost of living increases. We can see, I've given you an example of the differences between what we saw in April and what we're seeing in July at the moment. Huge increase in specifically for loan applications for this type of short-term credit to pay household bills. Since I've created the presentation, we've had the August numbers. They've kept relatively same, increased slightly. They're just into 140,000 applications that we saw in August for that purpose. The other thing that we are seeing is around the type of individuals actually applying for those loans. So what we see is that kind of young adult category of between 18 to 34 years old as being the primary people who are applying for this type of credit. Probably a number of challenges in there, less stable jobs from the back of the pandemic, likely less access to saving, again, as point Paul made before, and certainly people who've got less credit history, therefore are already at a disadvantage in terms of accessing more kind of near prime and prime lending. I did promise, Niall, I was trying to stick to 10 minutes. I think I'm broadly there. So again, snapshot, but all I would say is any questions, happy to answer. There's some details on screen there around how you can contact us, but hopefully that was useful and gave a bit of insight to everybody.
That is, thank you very much, Simon. Very helpful. Applications increasing, risk increasing, access reducing, applicant changing. All of this leaves a question of who is left behind as lenders tighten and borrowers are unable to meet affordability criteria. A reminder to everybody, not just of the portfolio analysis offer from Simon, but to put your questions and comments in the Q&A. We'll try and answer some as we go along, and we'll get to some later. If we don't get to them, we will respond to all of them when this is over. Next up is my colleague Kate Pender. Kate is across many of the responses that Fair4All Finance are developing. There are many strands to Kate's work. Kate, I think there are some real challenges here. Just a reminder that after you, we have 3 lenders waiting in the wings and scores more on the call. So could you maybe tell us a little bit about what is being considered within Fair4All Finance? We obviously responded very quickly during the beginning of the COVID crisis. Can you tell us now what we're considering now? What comfort, if any, can you offer?
Thanks, Neil. I'm not sure that this is a crisis in which much comfort can be offered, and it's probably important to point that out, because no matter what we do here, it's pretty grim for all of the people that we're trying to help. Just to cover briefly what it is that we're looking to do, despite that reasonably grim perspective, there are 4 key things that we've focused on for the cost of living crisis. The first is an awareness raising campaign. So what we've heard anecdotally from a number of lenders is that there is an increasing number of applications from borrowers whom they've not seen before. So somewhat challenging to deal with the figures that Pal and Simon have just shared, but also this rather interesting pattern of inquiries from borrowers in better circumstances than they'd usually encounter, but who are struggling for the first time. So we think that's quite an interesting pivot, and what we're looking to do is to run an awareness raising campaign to generate more interest and more high quality inquiries going to credit unions and community development finance institutions. We've been really delighted with the response that we've had from the sector to that. So my colleague Lauren Peel is leading our work on that, and we've got a working group that's including Responsible Finance and all of the credit union trade bodies, along with some lenders, working with a PR agency and a marketing agency, looking to really kind of up the dial on awareness raising work over the next couple of months, which we think is really exciting. It's obviously early days, but hopefully it's an opportunity to capitalise on that increased demand the kind of support that you all offer. The second thing I want to talk about is the benefit calculators and grant checkers, and I think you'll hear shortly from Shona, from Joanne, and from Paul about the number of applications that they're having to decline, where they're seeing people with budget deficits and really significant problems in terms of being able to manage their monthly budgets. And in that context, I think I speak for everyone when I say I find it really appalling that there's over £15 billion of unclaimed benefits every year, and that about 8 million households are missing out on entitlements. So what we're looking to do in that context for the cost of living crisis is test inserting benefit calculators offered by the likes of Income Max, Invest, Entitled To, and Policy and Practice into a number of places in the customer journey. So we know some lenders already have those on their websites. We're wanting to look at putting those directly into the customer journey in terms of the loan application route, and also to try and insert them wherever possible into price comparison websites and into the CRA sites where people are engaging with their own credit file. There's a reasonable body of evidence that that people simply don't know what they're entitled to. And there's also plenty of anecdote from people who are really up against it that they're already doing everything they can. So we know we need to balance the messaging on that and not to come across as presenting a panacea when we know it won't be. So one of the things that we're doing there is working with the behavioural insights team, who many of you will have heard of. They're essentially economists who help get language and positioning right, basically trying to nudge people into doing something that's going to help them. And the intention there is to try and get the awareness of those calculators to be much more prominent, but secondly, the conversion of people using them and then going on to apply for those benefits or grants from the DWP or from other providers. You won't be surprised to hear me say I'm not volunteering to try and make the DWP process more slick. I haven't quite got that heroic backbone built up just yet, but we're optimistic that this is something that can really help many people and on a sustained basis. So some of the work that's already been done by the likes of Invest with Scott Cash and with Salad Money show that on average people are missing out on £450 a month. That's really significant for some of those households. So that's what we're intending to do there. And my colleague Cynthia is leading on that work. We've recently had approval from our board for it, so we're just working through the contracting process with the providers, Policy and Practice, Entitled To, Invest, and we'll be looking to work with lenders, credit ratings agencies and price comparison websites to embed them as soon as possible. Many of you have probably heard me talk previously about the no interest loan scheme, and we've been delighted with the progress that South Manchester Credit Union have delivered for us in the small proof of concept that started earlier this year. Later this month, the full no interest loan scheme pilots commence, and it's a really exciting development building on that early evidence. What we're seeing through that proof of concept makes us think there's room for more no interest loan scheme provision. So if you're interested in delivering nils with us, please get in touch with me after the webinar. We can certainly have a chat about how to make that work. What's been really interesting in that proof of concept is that roughly 60% of the no interest loans that have been approved for people who were declined because there was something wrong in their credit file rather than because of an affordability problem. So that's been quite an interesting early learning. And at the moment, the arrears position on that is looking reasonable. So we are optimistic that there is scope to do more of that lending for the cost of living crisis. The final thing I wanted to touch on are our plans around consolidation loans. So again, really keen to see if there's a pilot that we can stand up there with a number of lenders to test that sort of impact on the circumstances that people are in. We've got an additional £4 million to put towards a consolidation loan pilot, and our work to date has been to design a partial bad debt guarantee to enable that kind of lending. It builds on a suggestion that Ellen from Hay Credit Union made to me when we did a webinar on the COVID fund impacts, and from feedback that we've had across the sector, that the thing that impedes consolidation lending is the bad debt risk. So the intention there is to appoint lenders who have some positive experience of consolidation lending, who've got a reasonable level of bad debt, and to provide a partial bad debt guarantee on a kind of evergreen fund. So essentially, we're trying to make sure that fund that we stand up can be scaled further. And to that end, the intention is that if that lending is done in a way that's profitable, we'd like some of that funding to go back into the bad debt guarantee so that we can extend it further. Again, if you're interested in delivering that with us, please get in touch with me or my colleague Vince Cox. At the moment, that plan is subject to our board approval, which we expect to be forthcoming later this month. And again, most of our modelling suggests that that could be quite transformational. So something like £3.5 million worth of bad debt guarantee could help up to 9,000 people and potentially help them avoid £21 million of interest charges. So that framing about making sure that we're helping people significantly reprofile the overall average interest that they're paying is really imperative there. That's all from me. Neil, I'll hand back to you.
Thank you, Kate. Listen, I realise out there that it's difficult to kind of process everything you're hearing and seeing in one go. So again, a reminder that these slides are available if some of those names passed you by around some of the issues that Kate was talking around, nils, more nils, debt consolidation, marketing support, benefit calculators, and the names that were kind of flashed past you, Vince, Senthan, Laura and others. Just write to us at hello@Fair4All Finance and we'll find the right person to get back to you if you didn't pick up all of the detail. We are delighted now to welcome three leaders in the sector who have been able to join us to give this a right bang up to date colour on what they are seeing. Shortly you'll hear from two credit unions, but first Shona Crichton, the new Chief Executive at Moneyline. Not new to Moneyline, Shona's been there, 7 or 8 years I think. A lender that specialises in loans to very low income households. High percentages of their borrowers traditionally drawn from lone parents with children and from social renters. Shona, welcome to you. It's a tough lending environment out there right now. I think you've got some insights from us from one of your customer types, I believe, on what you're seeing at the moment, the pressures you're seeing. Thank you.
Thanks, Neil. Today I want to take the data we've been talking about and see what it means for Moneyline and our customers. As you would expect, we generally receive applications from households with an income below £30,000. In August, we received and declined 100 applications from customers earning over £50,000, something we've not seen before, and our big question was, why did they come to us? The reasoning we can see is that there's very little alternatives left for small sum cash loans in the market, and people need to pay cash for the bills. However, we don't believe one of our loans is answers for these customers. Many are already over indebted and paying bills on their credit cards due to the increase in the bills. We're also seeing more and more customers earning above 20,000 coming to us as well for small sum loans to help pay larger bills or spread the costs of things that they would have been able to afford with a loan before from a credit card or maybe from a bank or even from their savings. We expect to see a lot more of these applications in the next few months. But it's also worth noting we're already seeing an increase in customers with defaults on their utility bills prior to any October increase in costs and prior to the heating being turned back on. One customer who will struggle to help going forward is Nina, someone who used to afford a small loan at Moneyline to help spread the cost of a washing machine or at Christmas. Nina lives on her own in a small town. Pre-COVID, she loved her job working in the local hotel. Unfortunately, the local hotel and pub didn't reopen after COVID, and without a car or a late night bus, Nina has struggled to get to the next town to get a job there. Here's Nina's affordability before and after the cost of living. Nina has always believed in budget and wealth, so when she went on to benefits after losing her job, she made sure she got everything she was entitled to. So she made sure she got the best mobile and internet tariffs for someone on benefits. She only spends £15 a week on food, so not much room to budget there. She pays her electricity and gas by prepayment meter, so always needs to make sure she has enough to keep this topped up. For Nina, meeting on a Friday night with friends is now about cooking some pastas together to save money rather than sharing a bottle of wine. And if it's over 10 minutes to cook, it's a definite no because the electricity cost for the cooker is just too much. It's kind of hard to believe that I'm talking about this in 2022. Nina, along with many others, will need other alternatives rather than interest-bearing loans. For some, and the O's product, which Kate talked about, may be the answer, but for others like Nina, even this will be a stretch too far. We are looking hard to understand what customers or products are suitable for in this ever-changing environment, and when we need to signpost customers when a loan is no longer the right thing for them. And that will be quite a large proportion of people that used to be in the subprime market. Thanks, Neil.
Fiona, thank you so much. Thank you for sharing your insight on your Nina Nearlys from Moneyline. I know it's very challenging. I see we're eating into the clock a bit. So thank you to everyone again for the questions and the comments. Sally, Jane, Lisa, Anna, and others. We will, if we can't get to them in this webinar, we will get back to you on them in due course. Next up is Joanne Angus, the Chief Executive at North East First, continuing this non-London centric view of this webinar. Joanne has transformed North East First over the recent years, and we're delighted, Joanne, that you could join us. What news do you have from the North East of England for us?
Yeah, thanks, Neil. I'm going to share some insights into what's happening around the North East. First slide. I'll try and be as quick as possible. I know we're eating into time here, and a lot of the information that I've got has already been resonated by others like Paul and his research and Simon. So what are we seeing in the North East? A significant increase in low value loans, typically the family loan, which is around £500. They make about 70% of our loan book at the moment in terms of numbers. Increase in applications to assist with the living expenses and household bills. As was said, very difficult to underwrite these loans now due to buy now, pay later, rising costs with utility fuel bills. Some people have chaotic lifestyles, multiple bank accounts where they're trying to sort of budget in different accounts. And we've seen a huge increase in gambling after the COVID pandemic. In terms of savings, our savings is pretty steady at the moment, and we've only seen a 2% drop on last year. Not to say that once the winter months start, then we may see people withdrawing money to pay their bills, their fuel bills. Our delinquency levels are fairly steady as well, up slightly, but in terms of the growth on the loans as well, that was to be expected. Our write-off rates are down, which is a good thing. And I just put a quick comparison there of August 2021 to August 2022. And as you can see, the loans that we're receiving has trebled. The loans that we've granted has doubled, and the value that we've granted has doubled. But as you can see, the percent that we're now declining is 67% in August were declined, which is pretty worrying on where those 67% of people are going to go for their credit. There's a little table underneath which has the 2021 and 2022 figures, and again you can see there the decline rate's gone from 41 last year to 60%. So that is one of our biggest worries. Where are these customers going when we can't help them? Next slide, please. So what are we doing about it? Well, we've got the SOAR banking platform. So we've used this to enable us to be able to deal with the growth in terms of applications that we've seen, applications of membership. And luckily, the platform's allowed us to grow without having to grow our staff, which has been a cost saving. But the technology that we use now is the inbuilt benefit checker that was mentioned by Kate, and we use this to identify if the member is due to any additional benefits or potentially due, and we send the link over to them and ask them, you know, if they want to explore that. We also use open banking through the platform, which categorises and analyses the spending habits of the person, which again is a great tool for assessing affordability. We are seeing in those bank statements gambling, direct debits, and they are identifying people that's been a member a long time who now haven't got the affordability, which is again a worrying thing. The open banking data that comes out of there that's analysed, we intend to share that with the member, whether the loan's either declined or approved, just to give them some insight into their own spending habits so they can make some decisions for themselves. Also, with our declines, we've started to signpost to relevant organisations that may be able to assist them when we can't. We already operate some no interest loan schemes with the local authorities and housing companies. They seem to work quite well. The delinquency rates are quite low. We've got some brilliant partnerships with local authorities, housing associations, citizens advice, which we share information continuously so that we can share that information with our members. With regards to marketing, over the last year, we've probably upped our marketing with an ecosystem of partnerships. We've increased our social media presence. And in June this year, we've appointed a business development officer funded for 2 years by a local authority. Next slide, please. So the North East has the highest rate of poverty in the UK, and people are desperately in need to access that affordable credit. You know, we've had a huge influx for example, school uniform over the last few months. The influx that we've had both in August and in September has been huge, and it's all been down to parents being able to afford the school uniform, which they've done so through applying for a loan through our family loan scheme. So how can we look after those loyal customers and the potential new members that no longer meet our affordability criteria? This is one of the biggest challenges we've got, and we thought, well, do we increase marketing, increase our reach, increase our knowledge across the North East, make more people aware that we're here? However, we can't help everybody, so, you know, and we do feel that in marketing we've kind of got that nailed now at the moment. More of the no interest loan schemes, yes, certainly we're definitely interested in doing more of that so we can help those most vulnerable at the lower end of the scale. Debt consolidation, we have done debt consolidation for a long time. Last year we reduced the amount we would consolidate due to the huge risks that comes with it. And you know, the biggest risk to the credit union's existence is delinquency. So I'd like to finish on an idea that we kind of batten around in the credit union at the moment, which is, you know, one of the things that we're trying to look at the challenges and how can we overcome that. And apart from signposting to citizens advice, an idea would be to employ some kind of in-house, maybe not debt advisor, but money advisor. And these could assist those members in accessing those potential benefits through the benefit checker, assessing debt consolidation. Are they suitable? Are they not? Is it something that, you know, would benefit them or not, rather than just, you know, just sort of sending them off to apply for it? Assisting with budgeting and financial education and support, and probably that ongoing wraparound care that we keep talking about that we need to do. So I'd just like to finish there on hopefully a positive. And thank you very much.
Joanne, thank you very much. Thank you for that. Again, huge amount of data and detail in the slides that will be available to everybody. I'm going to make an executive decision, and we're probably not going to have time for the Q&A because I want to make sure that Paul Norgrove gets absolutely the time he needs. I've seen his slides and you'll want to see them too. He's a little further south. He's in the West Midlands. Paul will be known to many of you as both the president of ABCUL, but also the chief executive of the Serve and Protect Credit Union. Very large, very successful, but I think some challenges that you're seeing as well, Paul. The floor is yours.
Absolutely. Thank you for the wonderful introduction, Neil. Really sort of mirroring on and building on some of the themes that have been identified today, really, that as a large industrial credit union serving those that serve and protect from Land's End to John O'Groats. The first thing we wanted to do when we knew this was coming, and the stats are taken from our own financial resilience survey of our membership, so I think we have a 13% response rate, was we wanted to measure. We have some nuances within our own membership, but also, some could be forgiven of thinking that our members may be not so susceptible to the challenge that we're faced. And I think this figure, if we measured again today, would be much higher. So this was taken in April, and 50% of our members then were already worried about the continued cost of living increases at that point in time on their own personal financial position. And this is one of the trends that we're seeing, is it doesn't matter really, to a degree, slightly contentious to say, whether you earn £10,000 a year, £20,000 a year, £50,000, £100,000 a year. Our understanding of our data shows that many people were living up to their means before this came along, and the cost of living affects us all. So many of us live without a buffer and have enjoyed low interest rate environment for such a long time. We've forgotten what it's like to see an increase in costs the way we're seeing them, a rapid increase. And then moving on to some other statistics that we saw, the spotlighted trends really were energy costs, and even though there's been some movement, it's probably still not enough. Concerns about fuel. Again, in April, that was dominating the news quite heavily with the war in Ukraine, and quite shockingly for the membership that we serve, nearly 1 in 4 concerned about their ability to feed themselves and their family. So that led us to really start thinking about what can we do, and the challenge that we faced really was affordable today versus affordable tomorrow. We knew what a good loan looked like for us at that point in time, but really something we're all doing as lenders and financial institutions is thinking about what is affordable tomorrow if we don't know. The goalposts are constantly moving. So we're a heavy consolidated lender. Over 50% of what we do is consolidation, based on really the principle of if done correctly, it's the only loan that any lender can do that makes their members better off. So really we were sort of looking at ways to open up dialogue with people, utilization of open banking, to see if we could support them consolidate some lending, based on the fact of trying to build some resilience back into their monthly lives. So the next slide sort of highlighted the question on where would people turn if they needed £2,000. It would be a loan. We pride ourselves really on trying to build a savings pot. The credit union difference of the money coming in not only gives us our lending capital, but it also builds resilience for our members. But ultimately, though, 1 in 3, just over 1 in 3, would need to turn to a loan. So therefore, some of the other trends that have been talked about today, that sort of micro lending, if you want to call it that, helping people in a time of need and emergency, launching new products, credit builders, referral schemes, both to GamCare and Step Change for those members who we say no to. Our conversion rate has gone down from 60% conversion to 49%. So, 10% increase in loans that we decline or are not pursued for different reasons. Maybe others go into other lenders during that time. And ultimately, on the flip side, in terms of what are we doing about it, trying to increase mechanisms for people to save so that people actually have financial resilience. But the actual challenge coming on the next slide was really in the first 6 months of our financial year, October through to the end of March, we had a 4.3% increase in savings across the organisation, and our portfolio is approaching 100 million. So it's, we have vast amounts of lending capital to get out the door. But we've now seen a complete shift. So since the 1st of April, that our shares have only grown by 1%, and you can see the stats on screen. that there's a 15% decrease in money being deposited to the credit union, and on the flip side, 30% increase in money being withdrawn. And the trend we're seeing, and we don't have the answer to it, which is why we love to get involved in these conversations, is for a credit union in particular, that's two ends of the spectrum. That's members utilising shares because they have less money for living costs, energy prices, etc. But also the sticky money that gives us our lending capital, that makes us the unique organisation we are. Members who've had it with the credit union for a market leading return for a period of time are now able to, because of the needle moving, the red line moving elsewhere, take money out and invest in other organisations, less ethical organisations that can give them a higher return. So we're sort of being squeezed at both angles. But again, that's why we want to get in conversations like today. That's why we want to work with Fair4All and the other affordable credit lenders to sort of find what solutions could be there, and collaboration could be something that we would discuss moving forward as an industry. So I'll leave it there. I know we're tight on time.
Paul, thank you so much. There are, I mean, just to make sure people see the numbers of people who responded to your survey, that looked like 3,500 to 4,500 people who are responding. So really conclusive stuff. Listen, I said earlier on I'd made a kind of executive decision. We are going to run out of time. As ever with these things, going to leave you wanting more. I've got an idea that I'm going to propose in terms of how we deal with some of this. I want to thank everybody firstly and just kind of summarise where we're at. So, what do we have in totality here? Just a reminder, all of this is available to you. Withdrawals increase, savings decrease, possible existential crisis, changing applicant, very different lending environment, all these challenges around affordability. Maybe some assistance coming in terms of more nils, debt consolidation, marketing, promotion, benefit calculators, all good stuff. You cannot really begin to identify solutions, of course, until you identify the challenges, and we've certainly done that, I think, with the research from Salford, which in and of itself is a valuable piece of insight. Evidence always beats assertion, doesn't it? And now we have some of it. We can, at Fair4All, I hope, play a role in supporting some of the possible solutions, some of which have been mentioned on the call, ideally co-created. Salford's research has been ably supported today by info from Simon, experiences shared by Shona and by Joanne and Paul. Our thanks to all of them for doing that, for taking so much time yesterday and last week to kind of prepare stuff. I know they are incredibly busy, and my thanks to them. Thanks to Temi and to Max and to Kate for all their help and Kate's preparedness for this when she was on holiday last week. It does feel, and this is my idea, it does feel like we should do more of these sessions, just in that kind of last bit, that kind of community finance bit. Experience, insight, shared learning. I think that would be something for us to look at and try and develop within Fair4All. If that's something that appeals to people, email me, email us and tell us your thoughts. Community finance, of course, continues to play an absolutely vital role in access to affordable credit for hundreds of thousands of people across the UK. £1.7 billion of lending in 2021, $1 billion of that in Britain. It's faced many challenges before, and this is another one. We all know the fantastic kind of creativity that people have and the determination to find solutions to what feel like intractable problems. Thanks to everyone for joining. Thanks for the questions and the comments to everybody who put them in and took the time. I will spend some time this afternoon kind of going through these, and I don't know how we do it, Max, but Max will tell me how we end up getting those back to you because he knows how to do it. We've got more research coming in the coming months. We've got research on benefit loans, we've got research on illegal money lending, we've got research on the challenges facing the Black, Asian and minority ethnic community. All of that is to come. You'll find more information about that in our revamped, revitalised, refreshed, any other word beginning with re that you can think of, our new website, which is up and running. All the links to all of this stuff at some time. I'm not going to say it's right there right now, but at some time all the links to all the stuff you've seen today will be there. Thanks to everyone for joining us. Great turnout. Have a good afternoon, and we'll see you again.